Anytime that Brent crude oil reached $104, it led to a recession. And listen, at a point for us in this time period, it hit $132.
What's up, everybody? Welcome to episode 14 of the Bag Talk Show. Today, we will be talking about the chances of a recession, the 5 factors that have led to previous recessions, and what you should be doing during this time period to keep yourself afloat so you're not scared. All right, let's just start with the chances of a recession, because honestly, they look pretty high and everyone's talking about them. So let's just get into it.
Everybody's definitely talking about it. It's a hot topic, you know? So we actually posted about this one. You know, Goldman Sachs put out an article stating they predict a 35% chance of a recession. 35%, which is pretty high, but we've seen higher. We've actually seen predictions as high as 50%, 60%, even 70%. All right, so everybody's trying to put out their predictions. The thing is, nobody really knows because nobody can predict the future. But what we like to look at is the factors that lead into a recession. So let's kick it off. What's the first factor we see leading into a recession?
So the first one we want to talk about is interest rates. So we've spoken about interest rates a lot on the channel, but let's just tell people what they are if you're new, right? So an interest rate is essentially the cost to borrow money. Well, if the interest rate is low and it's cheap to borrow money, everyone's going to borrow money, right? You have businesses, people buying cars now because they're able to borrow money, buying homes, buying all these new stocks. Everything is going great. The economy is functioning amazingly, right? So it's amazing. It's great. However, you're thinking, why would you ever increase interest rates then? Well, when you look at inflation hitting 40-year highs, this is not a good thing, right? Inflation is essentially when the dollar is actually losing its value. Now, a way to counter that is by increasing the interest rates. They have an inverse relationship. So at the time of this video, the interest rates have not yet seen a hike, but when you are watching it right now, Jerome Powell, who's the Fed chair, has said that he will probably increase interest rates by 25 basis points. If that happens, people will react, and now they're not going to borrow as much, which then leads to everything I just spoke about. So that's just one factor. We have so many more, and the second one is what? The yield curve?
The yield curve, man. The inverted yield curve, which has predicted 10 out of the last 11 recessions. So to me, that sounds pretty accurate.
I agree. I agree.
know, and you know, the inverted yield curve is a forward indicator. Okay, so it typically predicts things about a year out from it happening. All right, but you know, as you can see on this chart, when the line goes below 0, it shows that there is a recession coming. All right. Now, inverted yield curve, the yield curve, it has to do with the yield on bonds. What are bonds, though? You want to go ahead and explain that?
Yeah, I got you. All right. In the most simple format, bonds are essentially when investors lend money to other institutions or even just individuals in return for an interest rate, right? They're charging them a rate on it. Well, the reason why bonds work so well during a recession is because you can invest in government bonds, okay? The good thing to know here, the U.S. bonds, right, the government, it has never defaulted on their bond payments, which is basically a guarantee.
Yeah, it
right?
sounds guaranteed to me.
Exactly. So let's go back to why bonds are so popular during a recession. When you have governments saying, hey, we'll give you a guaranteed interest rate, just let us borrow money, the government takes that money, then invests in, infrastructure, construction, stimulates the economy, provides jobs to get everything back on track. In return, the government's, all right, cool, we're going to give you like a 5 to 6% interest rate. However, this doesn't sound too great, right? But when you look at the market during a recession, would you take 5 to 6% or would you take negative 20?
Exactly. We're going with that 5 to 6.
Exactly. So that's why bonds are super popular during this time period. And something is what? The 10-year, what's it called? Bond payment?
Yeah, the 10-year treasury bond.
Treasury, exactly.
Yeah, so, all right. So when it comes to bonds, right? Long-term bonds that are long-term, they typically yield a better, return for you.
Of course, because you want to incentivize people, right?
Exactly. They incentivize, listen, you hold this bond for a long time, we'll give you a better interest rate than if you hold a short-term bond.
Yeah, because as we said, bonds have such low interest rates. Why would I ever invest in a bond when I can go to the stocks? So the longer the term, the higher the interest rate.
Exactly. So that's how it's supposed to be. Now, in time periods like these, when people expect blood in the markets in the short term, what they do is they run to bonds. They run to these long-term bonds. The only thing is, if everybody's running to long-term bonds, guess what? It pushes the price of these bonds all the way up. And when the price of them go up, their interest rates start to drop because they work inversely. When bond prices go up, interest rates decrease.
Yep.
Now, they start decreasing to a rate where we have long-term bond interest rates being lower than short-term bond interest rates.
Which is not what you want.
Not what you want. That's the invert, right? That's why I call it an inverted yield curve, because they kind of switch positions. Whenever that happens, as you saw in the chart, it typically leads to a recession.
And I'm just laying here right now, it's happening. It's pretty damn close right now.
It might happen. It's looking like it, yeah.
So that's the second factor. So far, two factors that are saying a recession is going to happen, right?
Yeah.
This is the third one. We don't want to scare you too much. So, I'm going to slow down a little bit and just ask you to please like, comment, and subscribe to this video. Right. Any questions you have so far, make sure you comment below, because we understand it might be a hard topic to understand. So it's all good. And also hit that notification bell, because we do drop how many videos a week? 2
videos a week.
Exactly. So you don't want to miss out. But let's just go on to the third factor, man. Real wage growth. So right now, you're thinking, a lot of people are making money, right? People are buying houses left and right. The household wealth has now reached $150 trillion. So it's like, everyone's making money. Plus, the average worker has seen their pay go up 4.6%. Yeah. So you're thinking, this is even better. But we just spoke about inflation, right? Now, if inflation is at 40-year highs and it's at 7, do the math real quick. Or does that come to about 2.3?
Yeah, 2.4 if it was.
Oh, yeah, exactly. 2.4, 2.3, right? So that is a negative real wage growth, okay? So as you see on this chart right now, when it is a negative wage growth or is closer to 0, that is when a recession happens. Now, the Bank of America is coming out and saying that if this stays negative for the summer, does not look too hot. It says we're going to hit a recession, or we're likely to hit a recession. So that is now the third factor for you guys, which is indicating towards that direction. The fourth one is even a little bit more scarier.
Yeah, definitely. Man, listen, the increase in commodity prices, we've all felt this one, because if it looks at oil prices, right? So anytime that Brent crude oil reached $104, it led to a recession. And listen, at a point, for us in this time period, it hit $132.
So that's pretty scary, because 2008, when it hit 132, we all know what happened in 2008, man. It was not pretty.
Exactly. And listen, I will say prices have come back down since then. It hit 132, but now currently at the time of this video, it's about $101.
Yep.
But still, it's something to keep your eye on. And the thing when it comes to increasing commodity prices is it's tough. It makes people not want to spend because everything is so high. Like,
absolutely.
Think about it. Transportation costs are going up. Like, if I'm a business, it costs more for me to get my products.
Yep.
And when it costs more for me to get my products, it really costs more for my consumers.
Yeah.
Because they're the ones that's going to really feel the hurt when it comes to that.
Yeah, because if you think about it, right, like businesses are not sending trucks out anymore to deliver stuff. They're not, shipping stuff anymore as much. That's going to hurt their margins. It's all about margins for these guys. They don't care. Yeah. So that's why it hurts consumers so much.
Hurts consumers. And then so now when things are so expensive, consumers, we're like, hold on. We're not about to be paying anymore.
Facts.
So you kind of got an issue now when it comes to businesses that like, all right, it costs too much for me to get products. Consumers are like, it costs too much for me to consume.
Facts.
So the economy slows down to a point where it could lead to this recession where it getting at.
So just piggybacking off of that, when we're talking about consumers, that is the fifth factor, y'all. Consumer sentiment. So this is the saying, right? It's very popular. Those who say they can and those who say they cannot are often right. When you think about it, if we as consumers are saying, I'm scared of a recession, okay? I don't want to invest anymore. I don't want to spend anymore. I'm going to just save my money. What is that doing? Nothing. Literally, I'm not helping the economy. You're not helping the economy. You're not helping the economy. That's not good, okay? Yeah. So this report right here by Michigan University is showing what the consumer sentiment is, which is 67. Now, this is the lowest it's been in 10 years, which is usually the time gap between recessions. Yeah. So when you look at it, this is saying that right now we don't feel too good as the economy. Now, that is the fifth factor that shows why a recession might occur.
Exactly, because when it comes to consumer sentiment, if we all feel like a recession is coming, we start moving so defensively. It's like, why would I like be buying stocks and I don't even have extra money because I'm trying to buy necessities.
Facts.
Like who's trying to be paying for things that are like risky? So it makes everybody move defensively. And when that happens, like we said, slower economy growth.
Exactly. So those are 5 different factors that have predicted the past recessions, right? But this is the thing right now that you guys have to understand. There's a lot happening in the world as well that we have to take into consideration. Yeah. So, for example, when all this stuff was happening in the past, they were not dealing with COVID. They were not dealing with Russia and Ukraine war. So I know Russia had a big impact on what's happening as well, right?
Yeah, absolutely. So it's funny you mentioned COVID, which brought us a supply chain issue.
Yep.
Right? It was hard to get supplies from overseas. People were not even working. It was hard. Okay. Then now Russia and Ukraine have an issue.
Yep.
And we already know that caused more supply chain problems. And so now when there's a supply chain issue, guess what? The price of everything goes up even more. Okay, so we're trying to fight that because that's inflation in a nutshell.
Right. And we're trying to fight inflation because it's at 40-year highs.
Exactly. So it's like, all right, say we choose to fight inflation, then that means we have to do what? Increase interest rates.
Yep.
Which makes people not want to spend more. You're at a time where you're not trying to spend more. Everything is more expensive due to the supply chain.
Right.
So it's kind of like a tug of war. And at a point, it's like I said, people just be like, I can't buy anything.
Yeah.
And the economy hits a point of stagnation.
It's literally like picking your poison. Which one do you want to go with? Do you want to increase rates and then people don't buy more? Or do you want to deal with inflation? What is it? And that's why it's not good.
Nah, it's not. And the CPI has to do with consumers, right? Consumer Price Index shows how much that consumers are spending. That's inflation.
Yeah.
PPI is about the producers, right? And they're spending a lot to get things. So, like I said, everybody's spending a lot to get things, and when that happens, consumers don't even want to buy anymore.
Exactly.
The economy might have to slow down. And imagine that to get the economy back stimulated, they have to drop interest rates again.
Yeah, and this is just going to keep on spiraling. And then if the United States continues to do that, we're going to start losing our power as like an actual country, right? And that's not good. So that factor is just one. Let's just talk about COVID once again, because this is not over. China right now is going through a huge crisis with COVID. They have a complete lockdown right now. So you mentioned supply chain, right?
Yeah.
We all know everything's made in China, That whole supply chain issue is going to impact us. So that even builds to what we just said, which were the 5 factors earlier. So that is not good. Let's talk about right now, because we scared you enough, I think, what you should be doing during this time period to protect yourself, though, right? So you want to go first real quick, what they need to invest in, how they should maneuver?
Well, yeah, so if you want money like in the short term, you should look at like necessities, you know, because necessities are necessities. So if anything, you should look at companies like Procter & Gamble, you know, people look at Coca-Cola, Walmart, Costco. And if you don't want to get them individually, you should look into buying an ETF that has all these different companies in them. So there's ETFs like XLP or IYK. Those are 2 ETFs you can look into, XLP and IYK.
I just want to, my bad to cut you off, right? But the reason why, if you notice, the companies he mentioned are so amazing is because, yes, they're necessities, but look at what they've done in the past when you face recessions, right? Yes, you know, they go down, but then they recover really well, and they don't go down as much because you need food, you need water, you need drinks, you need cleaning supplies, etc., etc. That's why they're proven, right? And you mentioned ETFs. Y'all know I love ETFs, right? So at the end of the day, if you dollar cost average, you will be perfectly fine. We say all the time, dollar cost your average, or dollar cost your way to being a millionaire, you know? Because at the end of the day, if you continue to buy, even when times are rough, right, you average everything out, you use compounding to become a millionaire essentially. Because when things become stable, you'll be all right.
Exactly, you know, because some people try to time the market too much, and it's very hard to do that. And so what happens is, imagine you're like, I'm not buying stocks, the market hits lows, and if we do hit a recession like that, you might not even have a job at that time period. Or you might be spending so much money on necessities that you don't even have money to buy stocks. And so you really should dollar cost average in your strategy when it comes to investing.
Exactly.
Because you'll benefit in any market, really.
Yeah, and honestly, like what we do, we don't change up our strategy during this time period. It stays consistent. We don't go out and say we're investing a lot of money now. We're not saying we're investing a little money now. It stays consistent, y'all. Just do what you are told to do and believe in the markets because they eventually will recover because it's happened over the last 100 years, all right? It's nothing different. Just stay patient. And another thing, I know you said it, in terms of jobs, make sure you have savings, bro. Make sure you have a good amount of savings and stay closer to that 6-month gap because God forbid you lose your job, you know, you can't provide your family. then you're going to have some problems, which we don't want.
Definitely.
So
stay cash heavy.
Exactly. So that's what you really got to be doing during this time period. So I think that about summarizes everything we want to let you know. So now you know the chances of recession. You know what the 5 indicators are. You know there's all this stuff happening around the world, but you also know what you should be doing. So hopefully that provides you some comfort. Now make sure you let us continue to put out videos, and the only way we're going to do that is if you like, comment, subscribe, man. Yeah. And you got to hit that notification bell so you know how many videos we drop a week. Because, bro, what is it again? I can't remember.
We drop 2 videos a week, people.
Exactly.
Yep.
So we're going to get off right now and make sure you guys are staying safe and staying okay. We're going to check you on Monday, because for Rookie Mondays, y'all, you know what we do. But until then, peace.
Peace.